So when considering a smooth bonus product, it's really some key considerations that a member or trustee or fund decision maker really needs to make. I'd highlight these 4 key points. The first one being really looking at the size of the provider. Why this is critical is cross-subsidization really affects member outcomes. You can have more extreme volatile outcomes from a smaller provider simply because they are more susceptible to cash flow impacts from individual members entering and exiting the portfolio. There's a lot of protection against that when dealing with a very large smooth bonus provider, like the likes of Old Mutual's absolute growth portfolios, which are about 75% of the South African market share and are currently about in excess of 160 billion rand, which means you really have that protection from volatile outcomes in the forms of cash flows of new and existing members transacting on the portfolios. The next one I then highlight is specifically fees. So you could take a look at the investment management fee and capital charge, but what's ultimately key is to look at them together when comparing different providers, given that those can be represented in different forms when accessing the smooth bonus product. You could also take a step further and take a look at total investment charges to see all the different elements in the portfolio that are being charged for. But it is first and foremost really important to take a look at the investment management fee and capital charge as what would be charged to the member. The next one I then touch on as point 3, the different benefit events covered by that smooth bonus product. So there's generally a bit of consensus in the industry in terms of what benefit events are covered, and those would typically be death, disability, retirement, retrenchment, and resignation. But where I'd really like to hone in on is specifically retrenchments, where you do see differences in the treatments thereof. The first thing I'd really like to note there is that mass retrenchment is really where you might see some providers apply market value adjusters, which can be really detrimental to member outcomes, given that at a time of market distress, you might then experience retrenchment, which then could add a bit of insult to injury, unfortunately, by that member receiving even less as a result of a market value adjuster being applied. In the Old Mutual case, we do not apply market value adjusters to retrenchments, and that again speaks to a bit to point 1, because we have a very diverse book of investors, allowing us to pay retrenchments out at full book value. The final point 4 then that I'll hone in on is specifically noting guarantees. It is important to note the guarantees, how they operate. There's differences between legacy products. The newer products are a little bit more straightforward in how guarantees are applied, where it would typically be a percentage of fund value. So for example, on AGP 80, you have an 80% of fund value guarantee, meaning if you invest 100 Rand, you'll not leave with less than 80 Rand due to one of those guaranteed benefit events we mentioned in point 3. But it's important to know how that guarantee operates and whether there's a guarantee at all, because it is important that that guarantee is aligned to the risk appetite of the investor. Those are essentially the 4 key points I'd look at when considering a smooth bonus portfolio for investment.